Good morning. I'm Richard Calhoun, real estate broker here in Silicon Valley for 40 years. We'll come back to this slide in a few. This is the first data slide. We are showing supply and demand. I'll explain the three lines. The total line down here is total available inventory, the blue line. On the left of the vertical purple line is 2022. To the right of the purple line is 2021, but you must subtract 1 week. So week number 11 here is actually week number 10 in 2021. So what's this telling you? The yellow line is 100% of normal. By normal, I'm defining it to be the 5 years before COVID was announced, which is 2015 through 2019, 5 great years. If we were having a great year, everything would be on this yellow line. When the inventory is below, that means you have less inventory than you normally have. That tends to have a scarcity effect. You tend to have people bidding contests, multiple buyers wanting one property because there's a lack of inventory. Part of the supply side. The other supply side is the gray line. The gray line is the number of new sellers that are coming on the market every week. And basically, you can see that's right at the level, the whole time period on the graph. Everything, it's above, it's below, but basically it's 100% of normal. You might argue that it's about 5% above normal for 2022. It's a little bit hard to tell. 5% is not that big of a fluctuation. There have been 5% fluctuations within my base year. So I would call that normal level of inventory. Now we go over to the other side of the equation, which is the demand side. That's the red line up here. The red line has been consistently above the yellow line. So it's that surplus demand, the extra buyers that are creating the real havoc in the marketplace, which is why we're having so much overbid, so much competition, and so much appreciation. So it's this extra 10, 15% buyers are actually buying that are causing the lack of supply. And the reason I say that is the amount of new listings coming on the market every week is exactly where you'd expect it to be. The reason the number of listings available is so low is these surplus buyers have taken everything off the marketplace that was available. Now we look at the ratio between the two. This is the single biggest indicator, in my opinion. This is supply and demand ratio. How long would it take to sell the existing inventory at the current rate of sales? I call it days of unsold inventory. We're down here somewhere around 16 days of unsold inventory. And this is what I call macro data. This is Santa Clara County, San Mateo County, single family homes, condos, and townhouses all put together in a blender. And as we will see later in the presentation, it's not uniformly distributed, which means that some areas will have, some types of properties in some geographical areas will have less days of unsold inventory. Other areas will have greater days of unsold inventory. This is in raw count. So this time the yellow line is the raw count of what you normally expect. So normally you're expecting something like 23 days of unsold inventory. You're down somewhere around 16. Someone might say that's only, that's 60%. That's not that low, but the lower you get, the harder it is to decrease that number. So this is significantly hotter. I consider anything below 40 days of unsold inventory to be a strong seller's marketplace. So there's a big difference between from 40 being a strong seller's marketplace, 23 was a pretty outrageous seller's marketplace. And if this is the 5-year median, if the 5-year median is at 23, that supports my claim earlier that, the 5-year, my benchmark, were all 5 great years. But now we've actually put that on steroids essentially, and we're down around 15, 16 days of unsold inventory. Now we flip over and we look at what the buyers are feeling. This is the sale price to list price distribution every week of the macro property. So you have 22 weeks of data. The dotted lines down here are the oldest, followed by the dashed lines, followed by the solid lines. So you can see the general trend has been up to the right over as time has gone on. What's also interesting is the red dotted line here is the best month we've ever had. And this goes back to 1998, and it was April of 2018. And now the last 4 weeks have basically been equal to or surpassing this monthly data. So right now, if I was to pick, I would probably pick the burnt orange line up here as the best week ever. Yes, it does vary a little bit. You could almost argue that because down here, the current week, the wide, broad purple line is outperforming. and it's close to performing at the same level up here. Maybe the current week is the best week we've ever had. You can make that argument. At some point, I will probably designate one of those as being the best week, or maybe I will just stick and sort of average the best 5 weeks and plot that out once it looks like it is. But right now you got 4 weeks out here that are clearly the best 4 weeks. So if we get one more week, that would be the best 5 weeks. But what it's basically saying is we're in record high territory. This means buyers are feeling so much pressure, they're overbidding more frequently and by larger dollar amounts than they ever have in the past. And down at the other end by itself, lonesome is the worst month we ever had, and in between are the 22 weeks of data. Here's just list clutter, so you can see this is 12 weeks without all the extra data, but the concept is the same. The dotted lines are the oldest weeks, then the dashed lines are the next oldest, and then this group of 4 lines out here are the current 4 weeks. And what these 4 weeks are basically 4 weeks where the transactions were negotiated in 2022. So back here are 2021 negotiations impacted by the holidays. And, there's less buyers out there looking because of all the social events going on. And now the buyers are coming out of the woodwork and the sellers don't until a little bit later. And so you have this superheated marketplace that we've never seen before. This is sort of the breakdown and some of the key components. We'll start over here with active inventory. What do we know about active inventory? The only thing you have is the level compared to the 5-year median. So single family homes in Santa Clara County are only at 63% of the level you'd expect them to be. That's up a little bit from 60% last week. Not a huge change, but something to keep an eye on. I don't think the market's changing, and I'll explain that in a second. If you go to San Mateo County, it's at 91% of the single family homes. So there's a little bit of a shortage in San Mateo County, but really not much. That's an improvement or a worsening of the shortage actually at this point from 63%. Again, nothing to be concerned about. Go down to condos in Santa Clara County, and now you'll notice the font color changed to black, and that's because I consider anything between 95 and 115% of inventory to be a normal marketplace. So at 105%, that would be a normal marketplace. Again, no significant change from 102% last week. The thing that continues to stand out is my Bay Cities inventory, where I claim we have 227% of the 5-year median. I suspect there's an issue with my 5-year median, and you'll see that with the days of unsold inventory. They just don't make sense, and that's been the truth for the long time. So one of these times I will get back and look at that. Then if we move over to offers, we can calculate the rate of sales. And with the rate of sales, we can calculate the DUI, which is the single biggest indicator. So here in Santa Clara County, the biggest area, you're at 17 days. San Mateo County is outperforming Santa Clara County currently at 16 days. Santa Clara condos are 23 days, and the Bay Cities condos are at 16 days. So one of the things that supports my belief that my inventory is wrong, if you had 16 days of unsold inventory, that would suggest there's a shortage of inventory, just like up here, shortage 16 days, 60, 90. And at 23, you're basically at normal. I can't believe at 16, we have 200% of the normal inventory. And moving on to closings. With closings, we get sale price. With sale price, we can bring in the sale price to list price ratio. There's 2 major things. One is the frequency, how common it is overbidding. And you can see that 90% of the sellers are getting more than their asking price. There's also some that are getting their asking price. 90 plus, say, 5% is still only 95%. So there are 5% of the sellers out there that are getting less than their asking price. San Mateo County is not quite as strong at 85%, but 85% is still very strong. Down in the condos, 81% in Santa Clara and 78% in San Mateo County. Then you go over to the magnitude. This is how much of those buyers are overbidding. 117% in Santa Clara County, 116.5% basically in San Mateo County. Condos aren't as strong, but at 109 and 108%. On appreciation, my base year is the entire calendar year 2020. So I took every closing in the calendar year of 2020, found the median of that, and that was my base. So in Santa Clara County, single-family homes, you're up 34% over the base. San Mateo County, single-family homes is only up 18.6%. Condos in Santa Clara County are up 22%. And my base cities data is actually down 1.7%, or just approximately 2%. So you can see there's a huge difference between 34% appreciation to a 2% depreciation. That's a quick recap. So going over the URLs to join me Saturday morning, which I would appreciate, you type in the base URL, the green, and then add in 2022 for the year, and you'll get to the live presentation every morning at Saturday morning at 9 a.m. To get the handout of these PowerPoints, you add in S for Silicon Valley real estate market graphs handout, then the date, so 2022, 03, 05. Archive of my past presentation is just the base URL that takes you over to YouTube. And if you want a specific episode, you put in the year, month, date code. With that recap, I'll see if anyone's got any questions. Not seeing any questions, I will move on to the details. Now what we're doing is we're looking at the micro market data. DUI being the most important characteristic and the one that comes in from offers accepted, so it's more current in the data. This is the rate of sales and how long the existing inventory would sell out in each of the different areas. So you can see that many of Santa Clara County city areas are in the 15 days of unsold inventory range. Los Altos, Palo Alto is a little bit higher at 27. And then you flip over to San Mateo County, and if you look at that, it looks like maybe a lot of them are hanging somewhere around the low 20s. Obviously, there's an exception here in Foster Cities, a very small micro market area. It has only 9 days of unsold inventory. The base cities is sitting there at 13 days. The coast is at 22, Redwood City is at 27. The expensive area is Menlo Park, Atherton is at 53. That is the slowest area. My definition of San Mateo County, which does not include some of the very remote areas like La Honda, just because when properties there sell, it impacts statistical fluctuation. Since there's such a minor portion, I just left them out, and that's why it's Richard Calhoun's definition of San Mateo County. In Santa Clara County, I include every area, including the remote areas, because it's not as remote. Area 23 has quite a bit more activity than La Honda does. Condos, same concept, and you can see the range is probably somewhere in the teens for the days of unsold inventory. There is a color here at 67. It just happens to be white. Then going over to the frequency of overbidding, you can see Foster Cities is hitting 100%. You can't get higher than that. You have a couple areas here in the high 90s, from the moderate low areas, which are Milpitas, North Valley, San Andreas, Blossom Valley, to the moderate, which are Santa Clara, Campbell, Cambrian, Willow Glen, to even Cupertino, Sunnyvale. So they're all right at like 95% of the sellers getting over asking price. Very strong marketplace, but not far behind. Even East San Jose, Central San Jose, and South San Jose are at 88% of the sellers getting more than their asking price. So very strong, broad-based overbidding going on. San Mateo County, the same thing. You know, maybe 97% in Redwood City's up there, but the bulk of this area might be at 90% instead of at 95%. Condos and townhouses, you can see the bulk of the area there is probably like at 80%, several down here at 75, several up here at more closer to 85. Then the magnitude of overbidding has no cap, so those numbers can go high, and they do, 123%. Remember, I adjusted my cap. I think I started off with my cap somewhere around 112.5%, which was essentially close to the previous record, figuring that, you know, a little bit below being saturated red really didn't matter. Quickly, that got blown away. So I increased it, and I'm currently using 117% for saturated red. I think I'm going to stay there because once you're overbidding almost 20% above the seller's asking price, you can't get hotter market conditions than that. We're right now 17% is saturated red, and that's why all these colors are so similar, because most of the areas now are at 117% or more. There's a couple that are not, 106% for the San Mateo County expensive areas, and South County, Morgan Hill, Gilroy at 107%. Condos and townhouses on the same color scale are clearly backed off, somewhere around 108%. And it's amazing how close they are clustered, which is why they're all about the same color of pink. Now, for the first time, we go over to sale price, and with sale price, we're not looking at how hot the marketplace is, but we're looking at the prices relative to each other. So the redder the color, the higher the priced area is, the bluer the color, the lower the priced area. The white colors, which are basically typically Redwood City, is the median price for the area. The colors assigned based on the middle number. And so you can see that Redwood City is at 2.53 million, but Bay Cities is very close right now at 2.54, which is why they both appear to be white. So for Redwood City, it is going to be white. For the Bay Cities, there's an ever so slightly small hint of pink there. You can start seeing the pink up here in Cupertino, Sunnyvale at 2.7 million. So add 150,000 and you can clearly start seeing the pink. You add 600,000 and you can really start seeing the pink down here in Foster Cities. On condos, they have an independent color scale, and I simply took the highest priced area, made it white, and then took the lowest priced area, made it saturated blue, and there's two that are tied, and then the color scheme is linear between the two. Condos are much closer priced together, but again, these are on the low end, which is why I stuck with blue only color. Now we're starting to compare the number of new listings raw count versus percentage that we saw earlier to the 5-year median. So the 5-year median is the yellow line. Actual count is the blue line here. So you can see that when you look at it this way, instead of on a percentage basis, they are essentially right on top of one another, maybe shifted a day or two or half a week one way or the other, but that's your calendar shift. And that's why I sort of say, they're following on each top of each other, especially when you look at the history last year. So stories about all the sellers fleeing Silicon Valley, it's really not happening. If the sellers were fleeing Silicon Valley, we would have more sellers coming on the marketplace every week than we normally would have had. So it's my contention that the sellers are not fleeing Silicon Valley, that Prop 19 really hasn't brought a flood of sellers to the marketplace, and the number of sellers coming on the marketplace is exactly where you'd expect it to be each week. This is the total inventory, totally different picture here. You can see last year at this time, we basically had normal amount of inventory, but fairly quickly, you had less below normal inventory and it fell even further below. And this year we're starting off below, and it's hard to fall below 6%. We're almost to the point now where everything that's on the marketplace came on the market since Monday will be sold this weekend, even though the seller doesn't take offers until next week. Can't get any faster than that. And we're operating at about 60%, 65% of the inventory at that level, with about 10% extra, maybe 15% extra demand. But this is showing you just total inventory. My definition of total inventory are homes that are on the marketplace right now without a contract. So I don't count listings that are looking for backup offers. That first primary buyer has to walk away before a second buyer can come on the marketplace. Most agents, most consumers don't go looking for listings that are in escrow with a buyer that the listing agent wants a backup offer. They just wait till it falls apart and then go in. I don't count those. My inventory is lower than the MLS's for that reason, as they do count those backup offer listings, those listings seeking backup offers. Moving on to the number of new offers, same story here. And the yellow line is the 5-year median raw data. So the blue line is the current level. So now you're having a vertical separation. For the first 2 weeks, and this was a calendar event that I've explained in the past, but since starting the third week, the demand has been higher than the 5-year median. And you can see all of last year, the demand was higher. The holidays are spiked down. This is a 5-year average where the holiday falls over 2 weeks, so it mutes the holiday impact. When you're only looking at 1 year, it's only one. So the holidays really show up in the blue, and that's what's causing these down ticks. If you go back and look at it, you'll see this is probably Memorial Day, July the 4th, Labor Day, Thanksgiving, and then New Year's. So the story here is the number of new offers accepted, which represents the demand from the buyers, has been above, continues to be above, and that's why we have a shortage of inventory. Now what we're doing is simply looking at the ratio of those two, which is supply demand. Days of unsold inventory is how I measure that. The red line is Santa Clara County, the brown line is San Mateo County, and the yellow line is condos and townhouses. And you can see that we were strong before the pandemic was announced, had the huge slowdown. You can see the Christmas slowdown each year. Right now, you're basically at record low levels. Yes, we were lower right at the end of last year, on days unsold inventory, but real estate has a very strong yearly cycle. So you have to compare roughly the same time of the year. So if you take now beginning of March and come back here to beginning of March, you're basically in Santa Clara County. You were clearly lower earlier because the line here is lower, but right now it looks like last year, right this time, is accelerated fairly significantly. I'm not so sure there's room to accelerate. It'll be interesting to see if we see this little bit decrease here in 2021 come forward to 2022. San Mateo County clearly is lower because last year it was up here picking a number maybe around 24 days unsold inventory, and now you're below 20. So San Mateo County is clearly doing better this year. Santa Clara condos, I would actually say, is doing about the same, maybe a little bit worse, because you come back to March and, if you sort of average out that little spike, which is tough to play with the data, it might be something around 21, 22, and you're somewhere right around 21, 22. So basically performing the same level, I guess. This is looking at days unsold inventory in single family homes only. It's plotting out the days unsold inventory. The redder the color, the faster the pace of the marketplace. 7 days of unsold inventory, and none of the areas are down that low. It's saturated red from 42 to 75 is no color. So that's why the Menlo Park, Atherton area up here has no color, is it says 53 days, which is that no color range. But is no blue on here. Everything else is red. Now you're looking at the frequency of overbidding, and this is how common is overbidding. And you can see we're right up here at 90%. You can see last year we were pretty strong, spent most of the year somewhere around 75% of the overbidding. So we're clearly outperforming last year, which would tend to say buyers are feeling more pressure this year than they were last year. This is the frequency of overbidding by the micro market areas over time. Notice the rapid increase in up here. This is as we're coming into 2022 transactions closing and getting rid of any of the offers that were negotiated back in 2021. This is the map showing the color distribution of overbidding. So if you look at here, you can see broad, deep red. Those are just high frequency of overbidding, basically 95 to 88%. And I mean, you come down here, Saratoga, Las Gatos, it's a pinker color compared to the rest of the map, and it's at 81%. Los Altos, Palo Alto up here is also, again, slightly shadier. It's at 85. The coast is clearly less, and it's at 75%. Morgan Hill is probably one of the lightest shades down here at 77%. So you can quickly see the redder the color, the higher the number is, and that's the whole purpose. It's a visual thing for you. Here's the magnitude of overbidding. You can see we're at 116% last week. We dipped down a little bit. You can see there's a fair amount of sawtooth to this data, but you can see the huge amount of difference between this year and last year. Last year at this time, we were basically 107%, and now we're at 116%. So significantly difference in 1 year. You can see most of that jump up has happened since this year because, it was going up a little bit last year, 110%, but even this year it didn't get up to 112%. It was between 110 and 112%, and boom, now all of a sudden we're up to 116. And again, this is because you've gotten rid of the long closing transactions that happened in 2021. They're now in the rearview mirror because we're 60 days out. Everything that's closing now, or the vast majority of what's closing now, would have been offers that were negotiated in 2022. This is the micro market overbidding based on the county data. So you have the 3 data points: Santa Clara County, single family home in red, San Mateo County, single family home in the brown, and Santa Clara County condos and townhouses in the yellow. You can again see the huge increase in the last couple of weeks, and that's basically as we rolled over for the new year. This is magnitude of overbidding in the different geographical areas. The higher the number, the redder the color. You can see that from 101.5 down to 99, there's no color. 95% is saturated blue. And you might say, wow, that's pretty tight. It is. And the reason for that is historically, sellers don't negotiate downwards in their price. They wait, and buyers don't pull them down. The buyers wait until the seller reduces their own expectations. So sale price is very stingy on the way down, anything below 100%. But on the upward side, I go from 101.5% to 117.5%, 16 points to distribute my color on the overbid side. And I distribute that same color 4 times quicker because I only go through 4 percentage points to distribute it all on the lower side. And you can see that many of the geographical areas are above 117.5%. Palo Alto is very close at 117.2. So that gives you an idea coming right up here. That's your saturated red. And visually, I don't see the color difference between that and the completely saturated red. I don't know if it's my screen, my eyeballs. There is a slight computer difference, but it doesn't show visually. This now is looking at the median sell price. I normally track the 10 percentile and the 90 percentile as well. That allows consumers a sandwich price for the different micro market areas. This is just doing the middle point, the median. Red is Santa Clara County single family. San Mateo County is in the gray line up here. And then Santa Clara County condos and townhouses are in the yellow. And I'll just point out that this dip down here, I don't believe this was property values. I think it was a shift in the micro market areas where the less expensive areas were making up a bigger percentage of the marketplace. And therefore, the median price comes down, recovering that plus some potential appreciation causing the increase recently. Here's your map price distribution, single family homes only. The redder the color, the higher the price, the bluer the color, the lower the price. The white colors are basically your region's median priced areas. This now is showing the appreciation from the entire 2020 median price. And you can see all the prices for the most part are over here on the left. So almost all your micro market areas, in fact, I can say every micro market area has had a record high peak since January 22nd. The one going furthest back is South County, and then the expensive areas is San Mateo County. And this one's actually should not be yellow. So I'll get rid of that for next week. So what it's basically doing is showing you that prices are going up. I don't compare it to a year ago because by doing that, you have two impacts. You have the fluctuation from last year. What happened to your base? Was it an up week? Was it a down week? What happened, as well as the fluctuation this week? By taking the entire calendar year of 2020, you've established a nice solid base, and then you can see the appreciation that you've achieved on your investment since that period of time. If you want to get some concept, the median close of escrow occurred somewhere right around the first week in August. So if someone wanted to say this is the appreciation since August of 2020, that's roughly okay, but the peak pricing actually occurs in, further back in like April and May of 2020. But this isn't based on peak pricing. It's based on pricing for the entire calendar year. And that's why the August is probably a better point of view. That's where the middle transaction occurred, where the middle price, it's not necessarily where the middle price occurred, but it gives you an anchor. So basically in 18 months, these are the appreciation you have. And if you bought a house with 20% down, you're getting 5 times this posted rate of appreciation on your down payment money. Now what we're looking at is very close to an apples to apples comparison, but I normally look at this on March the 8th, which is still 3 days away. Instead, I looked at it on March the 5th. So it is an apples and apples comparison, but you can see at 484 days, we have the lowest inventory. This will close out basically at this number because you pick up Saturday, Sunday, and Monday because today's the 5th, 6th. I need Monday. So we'll pick up Monday. Monday isn't a lot of new activities, not a lot of new offers accepted. So this is going to finish out pretty close to 484. Up a little bit, down a little bit, not to be expected, but it's not going to catch 596. Coming down to days of unsold inventory and median, there's not going to be much change in this data. It is noteworthy. I've pointed this out the last couple of weeks now. At 4 days on the marketplace, right now, half the listings that are on the marketplace for a buyer to purchase have been on the marketplace for less than 4 days. So basically, that's my concept that almost everything's been on the marketplace just since Monday. And you can see that's a record low. I don't think we're ever going to see a number get below that based on when I take the data. I looked at this data during the week, it would fluctuate. If I did it tomorrow on Sunday, it would be probably a day higher. If I did it on Monday, it'd probably be 2 days higher because there's not a lot of new stuff coming on the marketplace, and nor are there a lot of listings being reported sold. This is the weekend is sort of stagnant. Everything happens during the week, even though the activity is triggered by the weekend. Days on unsold inventory 17, the lowest number, outperforming 2018, which was our previous best year. And remember, our overbidding showed that now 2022 was the best year we've ever had on that category too. Sales, this actually surprised me a little bit. I wasn't sure we were going to quite come up to this level, but at 971, we're selling more homes now than we've had in the past, and specifically several of the last years. Last year, yes, we did sell more, but we're now selling more homes with less inventory. So the people that were claiming in 2020, 2019, 2018, 2017, that we had so little inventory that the sales were being negatively impacted by the lack of inventory, that can't be true, because we're selling even more homes now with even less inventory. You might be able to argue we're down at that level now where it's impacting, and I would actually say it is, because with the homes not making it over the weekend, you're not selling out everything that was over the previous weekend. Back here, because these are all greater than 7, things were making it through one weekend and going to the next weekend. Here, you could have sped it up. Now, I think we're at a theoretical level where you can't get any lower, because yes, there are exceptions, but most sellers put their house on the market sometime during the week, hold the house open on the weekend, look at offers the following week. This number can't get lower than this. If all of a sudden sellers changed and would take offers as soon as they came in the door, this number could get down lower. It could get lower if I looked at it potentially yesterday, at 3 days, but that's just based on when I'm getting the data. So now you go down to closings, sale price to list price ratio, 117%. That's not to go one direction or another, but it's the best year ever up here. 90% is the highest amount of overbidding. And the appreciation, and you can't see it in this chart, but this number's gone up dramatically just in the last couple of weeks. I think it was flat from last week to the week before, but from about 5 weeks ago, it's gone from 1.650, I think, to 1850. Essentially, it's gone up $200,000 in about 5 weeks. This is comparing apples and apples, but it's going back now in time. This is January's data, so it's data as of February the 4th, or through February the 4th, gathered on the 5th. And you can see that this year was a pretty strong year. I'm not going to go into it all, because the February data is going to be very similar. And next week, this gets replaced with the slide we just talked about, but it's there for completeness. And with that, this is the URL slide again, and I'll see if anyone has any questions. Not seeing anyone with questions. Everybody enjoy the week. Happy house hunting. Take care. Bye for now.